David Burrows of Barometer Asset Management has brought with him 3 fresh top picks for a man who says he's the most bullish he's been in 30 years in the equity markets. We were looking at U.S. financials earlier. We had a call about Citigroup. You say, hang on, we got a better one for you, Bank of America.
So over the last year, I've talked about J.P. Morgan, Citigroup, and we have talked about Bank of America. So we're going to talk about Bank of America today. Look, we need to own things if people need income that will give them a rising stream of income to offset the impact of rising interest rates. Okay? People are very used to falling rates and became very complacent. Bank of America has a lot of levers. Higher interest rates certainly help them get better net interest margins. Deregulation can help them on the cost side. Better economic growth means their domestic business improves. 85% of their revenues come out of the U.S. They have a wonderful capital markets and wealth management business in the Bank of America Merrill Lynch division. That has 20% return on equity, which is the strongest and most profitable part of the business. So there's a number of things that are getting better. It's cheap relative to history at less than 1 times book value. And we think that you could see significant dividend growth going forward, north of 20% a year. So you get a yield, you're going to get some multiple expansion, and this stock over the next number of years, I think, could be a double or a triple.
But compared to Citigroup, for example, it's more expensive on an earnings per share basis and on a price to book basis. Right. Its dividend yield is virtually identical. And when you look at it, Citigroup's exposure to the United States versus the rest of the world, that seems to be the only fly in that ointment.
That is the fly in the ointment. I would prefer to be more focused on the U.S. domestic economy. It's the most resilient and most flexible economy in the world, and it's the one with the strongest, most resilient recovery.
Where do you see it 12 months out?
We don't forecast. I just think this can be a holding in a portfolio over the next 3 to 4 years that can be a lot higher than where it is today.
Top pick number 2, Dow Chemical. Why?
Okay. Sticking with the theme on cyclical companies, Dow going through a merger with DuPont, which should be approved sometime in 2017. There will be a spin out of 3 different businesses. This is a company that's grown its dividend just about 20% a year over the last 5 years. There's tremendous cost savings to be had. We like the industrials group. If you look at the stock price basically traded sideways for close to 3 years and recently broke out. So technically, you could see the stock move a lot higher. It's in a strong group. And again, it's a sector that will benefit from increased spending. The last piece is their feedstock to go into the stuff they produce. They have the lowest costs because you've got all this low-priced gas coming from U.S. shale.
Now, top pick number 3, back to the whole idea of getting out of mining and the low-price utilities, tech, which has been dumped on quite a bit since Donald Trump won.
Yeah. So look, this group led the market all year long. It was very predictable, and for good reason, because cloud-based computing is growing like wildfire. In their most recent quarter, they grew their Azure business by 120%. Software as a service is very attractive because it's very predictable. So in the first few days and couple of weeks after the election, people sold some of the leading technology companies to go and buy stuff they didn't own. But now you have new money coming into the market, and these companies haven't changed their business models. So Microsoft is not expensive. It's recently taken out the highs from 2000. I think, again, this is a way to get exposure to some secular long-term themes and get some great dividend growth along the way.
Cloud's only 29% of revenue. Still 42% of it is that old-fashioned personal computer business, and apparently we don't buy PCs anymore.
Well, the software as a service subscription model is a very attractive model. People wind up spending more, and it's more predictable than the one-time purchase, hoping that people will upgrade at some point. So these are both very, very attractive. The cloud business is an enormous business now, but it's going to be much, much bigger. The last piece is their purchase of LinkedIn gives them a great opportunity to monetize that business, the biggest purchase any software company's ever made.
David, good to see you again. All the best for the holidays.
And to you too, Michael.
David Burrows has been our guest, President and Chief Investment Strategist at Barometer Capital Management. That's it for this edition of Market Call. If you missed any part of the program, you can go to bnn.ca for the replay. The encore presentation airs Monday through Friday, 10 p.m. Eastern, 7 o'clock Pacific. And you can join us live Monday through Friday at 6 p.m. Eastern for Market Call tonight. Now, as always, please consult a qualified financial advisor before making any investment decisions. I'm Michael Hainsworth, in for Andrew Bell. I will be back in tomorrow. Andy's off for the afternoons all this week and then right back to his regular position here, so you can look forward to that. Thanks for joining us. We hope to have you with us next time. Take care.